Hello everybody, thanks very much for tuning in today and welcome to the Advisors Mortgage Innovators webcast series. I'm your host for today, James Mitchell from the Advisor magazine, and today is the first episode. We're going to be talking about responsible lending, which is a very important topic at the moment, given a lot of things which have been out in the media in terms of living expenses, and I know it's something that's very much on your minds as well. And the big theme or question, I suppose, of today is, has the game changed? So we're going to be debating that a little bit, and we'll also be taking questions from yourself as well, so do send those in. I'd just like to introduce the guests or the panel for today. Brendan Wright.
Morning, James.
From FAST, good to see you. Kim Dalton, Chief Operating Officer of Australian Mortgage Marketplace.
That's correct.
And we've got Brett Spencer, Chairman of Opica Group.
Nice to be here, James.
Good to see you. Good. Thanks for joining us, gents. And so we want to get stuck into this topic that I guess I want to give a little bit of context here in terms of why we've decided to focus on this for the first episode. And I guess, journalistically, looking at some of the stories that have been coming out in the mainstream press as well as from the Advisor as well, from the Royal Commission, from the Productivity Commission and Sedgwick and ASIC review before that, there's been this big focus on living expenses. The RBA's come out and talked about household debt fears, things like this. But meanwhile, we have a regulatory guideline for responsible lending, RG 209. I don't want to sort of lose viewers too early by mentioning an RG, but RG 209 is a regulatory guideline. And so I guess the question I want to throw out to any of you who want to answer it is it a legitimate link that people are making in reports when they say living expenses have become tighter, it's harder to get a mortgage because of the Royal Commission and the like?
I reckon that's you.
All right, fine. Look, I think that is. I think there's been a gross overreaction to the Royal Commission. It's put a lot of fear into the industry. And the first immediate knee-jerk reaction from our industry is to the most recent piece of advice that a regulatory body has given us, whether it's rightful or wrong, is what's being enacted upon. RG 209, as we talked earlier, is a great piece of legislation. It talks about expenses, talks about regulation, it talks about responsible lending. Seems the outcome of the Royal Commission has been very specifically focusing on the expense side of the equation. The original RG 209, people focused on the income side and the verification of can you afford the loan, not about what you can spend, because there's always been the statistical model. So I don't think there is. I think there is a bit of an overreaction, but I think it's a good overreaction for the market to really look at the one piece of the process that was never really looked at previously.
Why do you think it's switched from the income side to the expense side now? Why do you think there's been that focus?
Well, income's verifiable in God knows how many ways. 20 years ago when I first started doing lending, and Kim, it was tell us what you earned and we sort of believed you. Then it was let's get some pay slips and we'll believe you. Then let's get a tax return, we'll believe you. Then let's get a tax assessment notice and we'll believe you. And now it's let's get all of that and then let's still call the employer. And then it's like, oh, well, we still don't believe you, so let's get your bank statements and check that the money's going to your bank account. That's what has been the focus on. And we've always relied on this statistical model of expenses. It's whether it was the ABS stats, whether it was the Henderson Poverty Index, whether it's the HEM nowadays. All of those based on a universal basket of goods, doesn't take into consideration individual circumstances. Private schools, different types of cars. I use my brother as an example a lot when I talk. We both, in our businesses, paid ourselves a set salary, lived in the same postcode. I have 2 kids in private school, he has 2 kids in state school. He drives a Tesla, gets free petrol. No, doesn't petrol, gets free gas, gets a free coffee when he fills it up too. And I drive a Mercedes and it costs me money. We're assessed identically though, from an expense perspective. Who's the greater risk? My brother, who doesn't have private school fees or petrol costs, or me? But consumers don't disclose all that. They just disclose 2 adults, 2 kids, married, living in the same suburb, having the same income. So now I think that part of the flawed process is what's coming out.
The more granular detail.
Yeah, the more granular detail.
Yeah. Brendan, what do you reckon? Do you reckon it's a legitimate link that people are making?
There is some link to it, and I mean the journey started right back. Financial Services Inquiry rolled into ASIC Broker Enumeration Review.
The
Royal
spotlight's
Commission,
never been off, has it?
So we've been rolling thunder for the last 4 or 5 years or so, and I think what's important is to the theme of what Brett was talking about. It's about the living expenses, or the expenses are something that requires let's say, validation. And so what has changed is the need for brokers to have a conversation with their client to really understand what they do spend week in, week out. And those circumstances change over time, but at that particular time, what are the expenses? And people change their budgets, right? So if, jokingly, but if you're buying your first home, you're going to shift your lifestyle and what you spend money on when you go to buy a house, right? And that's some of the things that brokers now need to understand and know that, and then show it as well.
Yeah. That's a very important point, and in terms of changing your behaviours once you do take on debt, and I think we'll discuss that in more detail in a little bit. Kim, I wanted to get your thoughts on this.
I think it's very valuable to get into sort of consumer protection legislation DNA and to see why we indeed have the NCCP. It has its origins and genesis really in the catastrophe that was the GFC, primarily in America. And if you break it down, it was three things. It was to try and avoid predatory lending. We've all heard about the ninja loans, no income, no asset, no jobs. It was to avoid adverse streaming where financial services practitioners, whether they be brokers or lenders, put people into loans that weren't the most suitable for them, so they were chasing either higher interest rates or higher commissions. But overwhelmingly, the reason behind consumer protection legislation globally is to avoid over-indebtedness and people losing primarily the family home. And if you look at the NCCP, which in my opinion, in global terms, is a pretty bloody good piece of legislation, if you break the NCCP down, it's mostly about trying to avoid over-indebtedness, and that's where the focus on expenses has come, because as Brett quite correctly said, income can be readily proven, expenses are a little bit more difficult.
Yeah, and I know, like I mentioned before, that's something that the Reserve Bank has been worried about as well, that sort of high level of household indebtedness. I guess one thing, well it might be interesting to go back to your point, Brennan, in terms of the behaviours of consumers, of clients, of brokers' clients. When you might have a very different lifestyle prior to taking on a debt like a mortgage, and then you've got these monthly repayments. You will change your lifestyle accordingly.
Yes, definitely.
Because now you've got to service this debt. How much of a reason is that in the eyes of a lender? Is that a legitimate story that a broker can tell about their clients? They will change once they take on this debt, or is a lender saying no, they need to change before?
No, it's a legitimate story that the lenders do understand. I mean, what it requires though is for the broker to have that conversation with the client and detail it more specifically using expense checklists now. And so, from an aggregation perspective and a licensing perspective, we provide recommended expense checklists, and the challenge is that they can shift a little bit across the industry. So different lenders will focus on different expenses. Not totally different, but that's the challenge for a broker, and they're in business to provide debt, let's say debt advisory or credit advice to their client. So that's where they need to spend the time to understand those expenses, list them out, and then whatever lender they decide to recommend after they do their preliminary assessment will then understand what that lender expects around you detailing, for example, living expenses, and provide that. Most importantly, that theme of know and show, having that recorded in the platform that you use and before you pass it on to the lender, and keeping records of that so you can show that you know your client. Yep.
And Brendan makes a good point there, show. It previously was just tell me what you spent. Now it's show me what you spent or what you're prepared to spend. And that's got to be done in consultation with the broker and the customer. So it is, again, it's getting more onerous for the broker to do it, and there's multiple ways to do it using technology. We'll talk that using manual processes. There's varying ways to do it. Each person will do it differently, but it's now moving to a show me what the customer's prepared to commit to spending. We appreciate that there's a change of lifestyle. You're not going to go out to the expensive restaurant. You may go to the local takeaway instead once a month. Those sorts of things, and it has to come back to the onus on the customer to have that, not the word liability, but effectively the liability to say this is what I'm going to spend. And this is what I'm going to commit to, and in order to get this mortgage. And they'll do anything, ultimately, because what's the great Australian dream?
That's it. They want to get in the house.
They want to get in the house. And they'll do then everything to keep it. So they'll get rid of all their discretionary spending afterwards. They'll get rid of all their things their wish list of things to keep their house.
And that seems to be quite a uniquely Australian behaviour or trait in terms of home ownership.
Yes.
And very different, in terms of recourse, the US is a very different place, and
throw your keys back to the
old jingle mail thing. So I think that's culturally as a nation, I think that's an important thing as well. People
Yeah.
will take out a second job almost, to
Yep.
keep the mortgage.
But if I can make an observation, which is actually really a question, I call it the 6 pillars of the NCCP, and 2 of the pillars are to take reasonable steps to acquire and take reasonable steps to verify a person's income and expenses. My experience is somewhat anecdotal, but gentlemen, do you think the focus, incredibly granular focus on expenses now, I've heard anecdotally, and it might be an urban myth, but I've heard it, that lenders are actually saying, do you have a $20 a month or a $10 a month Netflix?
I've seen that.
To me, that seems like it's just a vast overreaction.
Right.
It's not what the Act actually requires, nor is it particularly prudent. Observations?
So there is examples of that. That's the changing environment we're operating in, and it will come out later on. And I touched on about the know and show and using for brokers using the platform that they use through their aggregator. But I know that Brett will talk about the value of technology and how you can help, collate that information and show that you know it. And I think that's a theme that's here to stay. To be honest, yeah, that's how the game has changed. Yeah.
And a lot of that comes down to, my belief is that lenders put the aggregators and the brokers through a certain degree of educational experience, qualifications. You must have certain industries, whether it's Cert 4, whether it's industry membership and that sort of thing. Unfortunately, when the loans then get submitted to a bank or any lender, quite often the people assessing those loans don't have the same qualifications or experience that the broker does. So, speaking from a lender's perspective, obviously owning lending businesses in our family in the past, which of course is now the Advantage business, it was a case that you had a set of guidelines you had to follow. And I think there is a fear in a number of lenders that if I don't follow the guideline to the nth degree and justify my decision to the nth degree, my job is on the line.
And I think that might be where the link to the Royal Commission and the scrutiny comes in.
It absolutely is.
Again,
Sort of like
fear factor.
it's the fear factor.
It's the overreaction to the most recent piece of advice. And the Royal Commission has come out. There was a comment that said perhaps relying on a statistical model to determine expenses is not the most prudent course of action. But whether one of the findings comes out of it saying that you can't do that anymore, I don't know that they'll do that. Again, and that comes back to each individual and having an interpretation. And I think that's where there's this $20 Netflix. We had I read somewhere online that a broker had a question from a lender about purchasing multiple purchases of shoes from a shoe store.
Yeah.
So, really.
Well, this is where I want to know where common sense comes into it in this environment of heightened fear with the Royal Commission. Geez, we better not step out of line here. We better check on their Netflix account because. And it comes down to this question of data, which is something I want to touch on, the open banking and that sort of stuff. Surely banks have the data. Well, I mean, anyone who's got internet banking, which is all of us, you can see how much goes in each month and how much goes out. And whatever the difference is, I mean, that's your expenses right there. So why does it need to be so granular, do you think, given that on a net sort of basis, all the information is already there on bank statements?
Look, that's a really good point.
Why do you need to fill in the fields?
That's the back of the envelope test, right? Okay. And we ask a lot of people the questions and at presentations, how much do you spend a month? And a lot of people go, everything I earn. So they don't know what bucket they're spending it in. And I think there is a degree
So the buckets are important.
The buckets are important because the buckets determine what is the difference between lifestyle expenses and living expenses. Living you have to spend regardless. Bills, food, all those sorts of things. Lifestyle, that holiday you took, that's lifestyle. You can do without that. So the buckets are important for the insurances. They're important because it determines, in the event of financial hardship, James, for you to keep your house and for me as a lender not to enact to you having to go into default, what do you need to spend to afford this loan?
Right.
So that's why the buckets are important.
Yep.
Whether that bucket shows in my discretionary entertainment that I'm spending $1,000 a month on restaurants and entertainment or I'm spending $3,000, the question really becomes is in the event of hardship, can I do without all of that? And the answer is no, you can't get rid of all your entertainment going out to restaurants because some of it will be replaced by having to shop for food. So your groceries will change. There is some common sense around that. But again, the buckets are important because they need to determine, and that's where I think the line needs to be drawn. Is what bucket of expenses is considered discretionary? And if Brendan tells me that I spend $3,000 a month on discretionary entertainment and travel, how much of that really can I do without? And that's what I think. Don't look at the granularity that he's gone and had Macca's and he's had a dinner at Vudamond or he's taken clients out to the pub or gone to the footy or gone to the opera with the wife. That's irrelevant. The bucket says I've spent this much money.
Yep.
How much of that do I think we need to continue? And I think that's where the over granularity nature of what lending assessors are doing, banks are doing, is taking it to the nth degree.
I've got one question. It just popped into my head. It's a bit of a curveball, but I'll ask it before we move on. Let's say a broker's got a client going through their expenses, got the bank statements, and it's clear that there's money going out each month. Client might have gambling addiction, gambling habit, you know, making big withdrawals every month. What bucket does that fall into?
It's a very interesting question. If it's my view, if it's a recurring expenditure, something such as gambling, the very definition of gambling is it's discretionary spend.
Yep.
If it's a recurring nature every single month, there is an argument that the lender can say this is an ongoing expense. Because something like gambling or alcohol, for example, can talk towards addiction and mental health and wellness and those sort of things. And you obviously talked earlier. That becomes the grey area.
Yeah.
That sort of an expense is a legitimate one that
It's an interesting question, though.
most definitely a broker and a lender and the customer should question that type of expenditure.
Yeah.
The rest of the types of expenditure, as we see, the shoes, the Netflix, I think are irrelevant.
Yep.
But those ones that really talk towards the abilities, because those things can spiral, and the behaviour, they can spiral out of control.
Yep.
And that's really what, and there obviously was the famous Westpac case around gambling. So that's a really if I was the lender and it was a recurring, constant, you'd have to almost sit there and ask the question.
Yep.
Yeah.
Interesting. Brendan, I wanted to ask you from an aggregator's perspective. There's been a lot of talk about licensing at the moment, ACL versus credit rep. Where do you stand on that sort of stuff?
Yeah, an AND story from a fast perspective. So we believe that brokers as business owners can, if they choose to have their own licence, we're prepared to support them in that, or they can choose to have our licence as well. The difference is around, for those that choose to have their own licence, we use the learnings of having a big licence to ensure that they've got the right compliance, regulatory approaches in their business to ensure that they can continue to operate in a sustainable way. There's responsibilities in both, but you're certainly taking more on by holding your own licence, but there's reasons that brokers choose to do that, and we support both. There's a place for both. Yeah, absolutely.
Well, what are some of the reasons that a broker, do you think, would decide to go down the ACL route rather than?
Yeah, so predominantly the reason is broader offering of lenders on their panel, so to speak. So quite often it's a broking business that tilts, not just doing mortgages, tilts into other forms of finances as well. Yep. So into business lending and asset finance. Typically, not always, but typically. Yep. Or historically, brokers used to always get their own licence, back in the early days, pretty much. And so there's an element of that. Yep. Most broking businesses that start these days will pick up an aggregation, be a credit rep under the aggregator's licences, but not always, depending on the nature of their business. So if there's a tilt to go beyond home lending, that's when quite often businesses choose to use their own licence. Yep.
Sticking on the responsible lending topic, and it speaks to that willingness, I guess, to broaden your panel as a broker. I've noticed that over the years, things like turnaround times have become a competitive dynamic, a point of competition. Who will get the loan done fastest? They're who we're going with. At the moment, where you've got tougher, restrictions that on living expenses, but you did note that people have slightly different buckets. Do you think that has become a level of competitive tension that brokers could choose a lender who is not as onerous with living expenses? Is that the right way to do things?
I think this is my view on it. So first up, it's not necessarily quickest turnaround time. The competitive advantage has always been consistent. So what I mean by that is, for the lender, that the broker knows, well, I'll get what I need as in an answer or unconditional in this amount of time, and they're consistent in that. I've got a message to my customer, and so there's no surprises, as long as it's not dragged out too long. Where we've got to today, everything is taking longer to get done. That's the reality of the business and the game and the industry that we're in these days. And I think it's the opportunity for lenders is to be clear about their appetite. These are the type of customers that we are looking to do business with. Be transparent.
Transparency and consistency.
There's an opportunity to be consistent around living expenses, as an example, and the the living expenses checklist, there's an opportunity there. But we need to remember though, competition is important as well. And so, you're not going to get everything exactly the same because competition is important as well. We're in an industry that creates competition. So that's our view on it.
Can I just pick up on something you said?
Sure.
I hope it's not overly pedantic. There hasn't been a tightening or restriction or a change to the requirements. They've always been there. It's just how people are interpreting them that has changed. I think that's a critical point, actually.
So has the game changed?
Well, it's how you're interpreting it has changed. I would contend that the game has not changed. It's always been there. It's, I'd recommend everybody read the RG209 forensically again because it's really all there.
Yep.
I think something that has shifted though is so not unsuitable is appropriate, right? As per RG209, but given all that and I mentioned it before about started off with financial services inquiries, ASIC broker enumeration review, etc., but
The long train.
Yeah, the long train. But look, the Combined Industry Forum and the good customer outcome definition is what brokers should have in front of mind when they approach their customer. To be honest, whether it's a home loan customer or any type of customer that they're providing financial services or debt to, they follow that good customer outcome and that intent of I'm putting your interest ahead of mine. That simple approach will keep them in good stead.
Yes.
Yeah.
Heartily agree.
But that good customer outcome, how deeply rooted is that message getting to the coalface brokers? It's obviously coming from the CIF and it's coming down through groups and through. But is every broker getting that same message? Are they getting that across and understanding that is, or is the reaction the fear about expense verification and this and the other changes? And that's
I think that's a very good point, Brett. I mean, it's brokers in their business and they're trying to look after their clients and they've got a lot of noise in and around them.
That's right.
The short story, in my view, is that the message is getting through, and I think that's off the back of look at the members of the Combined Industry Forum. You've got small, medium, large lenders, small, medium, large aggregators, 5 industry bodies, the consumer advocate choice. It is and the message is getting out there. And the message to the brokers that are tuning in today is to understand that the good customer outcome and what that means for them in their business. They should talk to their aggregator and have conversations about how that you can apply that culture. I call it the know and show culture and that good customer outcome in their business.
With that focus on the customer, I want to ask Kim. In terms of, I mean, you believe the game hasn't changed. It's always been there. Responsible lending is still responsible lending. You just need to read the documents and go to it. Good customer outcomes, of course. That's the goal. That's what came out of ASIC and that sort of thing, which they're looking to achieve. But where does the line get drawn in terms of the borrower's responsibility when it comes to borrowing, responsible borrowing.
It's a great term.
Because they want the house at the end of the day.
Associated with that is responsible spending. The two things are actually interlinked. To spend, you usually have to borrow. And I think the CIF I know has come out with what's basically a definition of responsible borrowing, which I really like. Actually, endorse it. But what helps responsible borrowing? And seemingly every time we have a commission or a report, there's a general clamour for increased financial literacy, a subject very, very dear to my heart. Really, that's quite often like a faith-based mission or a conscience salve, because it's my opinion that generalised financial literacy really doesn't have much impact. As I'm fond of saying, it's like trying to teach a 5-year-old sex ed. It actually just lacks context, So I would endorse increased levels of financial literacy, but I'm a passionate believer that it has to be proximate to purchase, as I call it, and it has to have context. It has to be related to the product that's being sought or acquired to have real meaningful impact. And I think that would be a key point in endorsing responsible borrowing. But there is in behavioural sciences there is a phenomenon called the optimism bias. And so people actually apply for loans in the expectation that things won't go wrong or things will get better. I think it's beholden upon lenders and brokers to actually just be aware of the optimism bias and encourage people to actually borrow responsibly.
Yeah, look, from a responsible lending perspective, it's the onus is really on the brokers these days now to even more so have the right conversations with their clients, deal with the optimism bias, Kim, and really ask the right type of questions to understand what their living expenses are, what their debts are, and make sure everything's disclosed, because it's in their best interest that there's no surprises down the track as best you can. I think that's something that's, those conversations have always been had, but they need to be had in an even more genuine, authentic way, and then record, know and show, so that you can demonstrate to the customer that you're putting their interest first as well.
Correct.
Now, I acknowledge that doesn't necessarily mean, that means some tough conversations sometimes,
definitely.
but that's the reality of the game we're in.
And from the consumer speak, they have a little bit of knowledge.
Yeah.
And that, the old saying, a little bit of knowledge is a dangerous thing.
Absolutely.
And talking to a lot of brokers, they're having to educate most customers when they come to them who go, I want to buy that house for $1 million. And it's like, oh, how much do you earn? I earn $100,000. Well, you can't afford a house like that. Your expectations are too high. And a lot of that is generational. I don't just use the age gap basis. When I say generational, I mean time generation. We're in the society today of Generation Now and Generation Me, regardless of age. We want everything now, we want it for me. And so there is that education piece that in order for you to buy that house, you need to start thinking about your financial position 12 months in advance. Not everybody's going to go to a financial planner, because there is a view that financial planners are expensive and that they're going to do insurances and super and basic sort of things. But it's the expensive side. People don't want to necessarily spend money if they don't have to. Is that if you want to buy a house in 12 months' time and you're a renter, you've got to start thinking, what deposit do I need? How much money can I spend? Where do I want to live? Quite often people want to live in an area where they're renting. So you want to live in Richmond in Melbourne and you're paying $600 a week for a nice 2-bedroom apartment. You want to buy a 2-bedroom house in Richmond, you're in the $1 million range. Comparative speaking, spending $2,500 a month on rent is not going to meet the same amount of mortgage payment that you're going to be doing on a principal interest basis to get the cheapest rates. So there is that education. People, what can I afford and what can't I afford? There is that younger generation. It's been written a lot of time. Whatever, Gen Y, Gen Z, Gen Me, whatever you call them. I want the big mega mansion that my parents have worked all their life for and paid off over 20 years, but I want it now as a 25-year-old.
Interesting.
And that's yes, it's a stigma, and I don't subscribe to that, but it's a stigma that's been pushed out there in the press a lot. And that comes back to the financial education, the literacy of what the consumer needs to have, and the responsibility of responsible borrowing. Can I actually borrow money? And if somebody says no to them, they'll go to the next person who'll say, oh, we can get you a little bit closer if you do this. And we'll go. And there is that discussion of branch-based loans versus broker-dominated and two different standards. I guess we'll talk about that later. But a consumer will always find a way to get what they want.
Yep.
And if that means they've gone to their first broker and they've disclosed everything and they can't qualify, great. They'll come back 3 months later to another broker. They've learnt from their mistakes on what they should and shouldn't disclose.
Yes.
And then they'll disclose something different. They might disclose less credit cards. A broker may not find it. A lender may not find it. Great, they've got their loan. Well, they get declined, they'll go to a branch. So there's lots of ways. One thing we have to never fail to underestimate the persistence value of someone who wants that end goal.
That's true.
That's human nature. Persistence.
A left field question that has popped into my head.
Did it hurt?
Yeah, size of my head. Is that what do you think, if any, the impact of 25 years of house price appreciation has had on people's optimism bias? I mean, this feeling that even if I overextend myself now, if I get into trouble, I'll just sell the thing and I'll probably make a profit. Is that a factor, do you think?
I think it used to be, but not anymore.
Not anymore.
I think that's disappeared. Yep.
Yeah.
So, look.
You mean knowing that their property will generate wealth for them?
Will cover their debts and cover their problems.
Yeah,
so I can get out and it's going to be worth another 10%.
Well, we were certainly in there was a roll on with price, property values going up almost everywhere for a while, but that was, leaning towards, without going into economic levers, etc., that was leaning towards, chances of overheating markets.
Yeah.
And we saw APRA do some things around, causing banks to do things around interest-only lending and lending for investment properties, which, that legitimately took the heat out of the market. And so I think there used to be that, Kim. I think it's gone now.
Yeah.
I think if it's an investment, people will get rid of it. But when it comes to your own home, which is, I don't think people. I think they'll do everything. I know I would. I would do everything possible to keep my home. As a family man, I've got wife and children.
School.
Exactly right. You want to do everything. If it means getting a new job, getting a second job, selling my Mercedes and buying a Toyota, you do it.
You go to any lengths.
Exactly right. I think I think it comes back to what we talked about earlier. The psyche in Australia is it's the great Australian dream to own our home.
Yep.
That was our grandparents and their grandparents. That's the dream, and it's instilled in us as our DNA.
Yep.
So I think whilst in some countries it is quite common, just throw the keys back. You know, I think here, from an owner-occupier perspective, no. I think investment, I'd sell every investment property if I had a portfolio. It'd be the first thing that would go.
Yep.
Right.
Yeah.
Brett, I want to stay on one thing that you mentioned, and it's a really important point, and it's something that brokers have actually told me about personally, either on or off record, usually off record. But it's basically, a client will come and see them. They won't be able to help out that client because of X, Y, Z. It might be a living expense thing. In fact, most often than not, it's a living expense or it's an income issue.
Yep.
Which is why the loan can't get approved. That customer then walks down the street, goes into the bank branch, teller approves it, and happy days.
Yep.
And we've all got the same hymn sheet here. One would have thought RG 209 in terms of responsible lending. Are we singing from the same hymn sheet, or are there two sets of rules?
Interpretation, as we said earlier, one group's view on how to interpret the rules. And I also say consumers get smarter. We learn from our mistake. If you're very honest, but you ultimately want that. It comes back to, again, responsible borrowing. The onus has to go back to the customer about what they're disclosing to both parties, to both the broker first and then to the branch. Do I see that there is a differentiation between first-party channels and yeah, I do. I do. And anybody who says there's not is just blowing smoke. There is a very open view that lenders, if they've got first-party channels and direct channels, will do everything they can. There's a greater margin for them. The whole works. Should that occur? Well, I don't believe so. I think if you're going to offer a product, but competition, it's no different than having a broker group or an aggregator group who's on top tier level and an aggregator group who's on bottom tier level, on whether it's commission splits or whether it's performance, whether it's turnaround, preference, whatever. But I think there is certainly a space where consumers will get a loan decline through a broker channel and they are walking into branch. And yes, you're right. I've seen it. I've heard it.
And there's incentives as well. They're offering cashback and this sort of stuff.
The cashback. One of the big four banks released a new cashback this week, so that I don't believe is available through third-party channel. It's available direct walking into branches. That's competition. It is a form of competition. And they're open about it. And they say it is a form of competition. And I think as brokers we have to accept that and understand it. But I think brokers, so long as they do the right thing, and they do everything by the book, nobody can turn around and say that they've done the wrong thing. The backlash can't come back to a broker or an aggregator who's done their responsible lending process. They've verified the income. If that consumer's then gone to another person and the branch and not disclose their 2 credit cards somewhere else, and the branch has just gone, well, our bank just says we've just got to use him as our number, then what can be done?
Yeah.
It's effectively the consumer being fraudulent.
It's a great segue, actually, back to responsible borrowing. And I believe the CIF is making some initiatives in this direction, is that right now there's no particular sanction against irresponsible borrowing.
Yeah.
Well, you don't get the loan, but there's no real sanction going forward. And I think perhaps as we explore the world of responsible lending further, there should be. If you're a serial offender.
Well, a register would be
that's
pretty good if you know.
That's where
I'm sure there's a lawyer at every lender who would have a view on that. Why you can't have a register? Why you can't have a register of those things?
some form of sanction against
But
flagrant irresponsibility.
Kim's exactly right there.
Yeah.
If you look at, we talked earlier about people changing their spending habits after they've got the loan, and I've never in 26 years I've never heard of a case of a lender going back to a borrower after the event that they've taken their loan, they're making their payments, and then the borrower going on a hindsight audit going, Brendan, you lied about your expenses in your application.
Yeah.
I want my money back.
That's true.
They're making their payments.
Yeah.
They've lied flat out to get their application. It's happened a long time. There was the liar loans.
The liar loans. Thing.
That's exactly right.
Geez, that got a lot of airtime.
It did get a lot of airtime. Yet, find me a lender that's actually said, okay, you lied on your loan, I want my money back.
Yep.
None. It doesn't happen.
Yep.
So there is no recourse back for the lying. And in the event that there is a problem down the track, this is what the Royal Commission now focuses on, the problems down the track.
When you look at the delinquencies and it all looks pretty stable at the end of the day, you know. But I mean, it's and going back to mortgage brokers and I guess how they can better serve their clients and run their businesses effectively, you know, and in a streamlined way, because all of this stuff takes time. I want to sort of talk now a little bit about the solutions, you know, about what can be done in the current environment, and then I'll go to some questions from the audience, from our brokers. So in terms of innovation, Brennan, I might start with you as an aggregator. You know, technology plays a huge role in aggregation now. In terms of how you're working with brokers with living expenses, with responsible lending, well, what are some of the conversations you're having with them at the moment?
So the conversations, some of the themes have already come out around, you know, ensure that you're having those conversations, quite often tougher ones, about really understanding what the customer's spending,
clients,
and what's their asset and liability position as well. So we're talking a lot about living expenses, but quite often, you know, debts can get missed. And that's not a good outcome either for the customer or the broker as well, and appropriately so. I mean, lenders are doing proactive reviews to ensure that the themes of responsible lending and quality of submissions are being made by brokers. And so with that in mind, it's not just the questions, it's about what we've touched on before, about using the aggregators platform to record the conversations that you have. So, you know, a living expenses checklist, notes where appropriate, all those type of things. And then there's technology coming, which I know that and in the market, which Brett will no doubt talk about, that helps brokers do that. And so it's being the brokers should, you know, really understand how they can use their platform that their aggregator provides them as their business operating platform. So it's about lodging your home lending solutions, and more than that, to the lender that you decides right for your client. It's recording of the expenses, it's marketing or communicating to your client as well, because down the track, like very shortly, we will as brokers need to demonstrate that we're regularly in contact with our client, because we are appropriately earning trail, because we service that client and we meet their needs and we ensure that they're being looked after. And so to do that, we should use our platform. So there's a number of examples where technology in the platform is key to sustainable success for a broker.
I just want to ask one more question before I move on to Kim, and that's, if brokers are having to do this much work at the moment and speak to their clients as regularly as they are and get all this information and the KYC and focusing on good customer outcomes, is it not quite quite a small leap to make then to do like a full budgeting and financial coaching service for those clients who might need that?
There's an opportunity for brokers to do that should they choose to do it.
Where does advice come into that?
So there's clear rules about when you're providing financial advice, but that's really, you can still be provide debt advice, credit advice, and provide strong budgeting themes and support as well for a client without stepping into financial advice. Absolutely.
I think that area is quite exciting.
Yep, it is, absolutely. Yep.
It comes back to education too. Brokers have got to want to do that. They've got to educate themselves on what they're providing.
That's true.
And of course, if there's an ongoing commitment to what let's call it credit planning, it's is yet another justification for the retention of trails too. So there's a pragmatic element to it.
You've got to have the willingness of the customer though too. Kim, what are your thoughts on terms of innovation and responsible lending? Where can it come in?
I'd leave the use of data to Brett, a subject close to his heart, but I think there's a real opportunity for lenders into the future who use scientific responsible lending. I think the current focus is an overreaction. It's not as required as is reasonably required by the law. And I think from my perspective, a genuine commitment to impactful proximate to purchase financial literacy, so people know that the loan is not unsuitable and that they can repay it without substantial hardship, is an opportunity for innovation. And also perhaps measuring that comprehension. So if anything does go wrong down the track, the lender and or the broker can actually say, no, we did actually teach you about that, and you confirmed that you knew what you were doing. I think that would be an innovation.
Know and show, Kim. Know and show.
That's it. Brett, tell us what you've been up to in terms of this space.
Look, this space, again, it's an overreaction. I love the overreaction, obviously. It's certainly been great for the Opica business and our Rely Check platform.
Yes.
But not doing the self plug. The market needs something. It's a task that needs to be done. Responsible lending, RG209 has been around for a long time. The overreaction is, how do we look at expenses? And there is a number of technology providers that have come out, including ourselves, who can provide the data, can provide you with the bank statements, can provide you with the customer with being able to give you easier. Brendan, as an aggregator and broker, you know brokers complain all the time about getting information from the customer. You've got to make that process easier. So there is a lot of the data harvesters, and including ourselves, provide those capabilities for brokers. But the key is having the data is one thing, but what do you do with it?
Yeah.
So, okay, yeah, you've given me 12 months worth of bank statements. As a broker, what do I do with it? My first thought is, oh shit.
Yeah.
Like, what am I going to do with it?
Yeah.
Like, that's my
big job in front
I've got a
of you.
big
A lot of
job.
paperwork,
That's my first thought. Like, what do I do with the data? And unless you've got, you're adopting artificial intelligence, machine learning, all those buzzwords today, that you can have a platform that does it for you. You can take a 5 or 6 hour job, or even longer, for those complex transactions, and do it in 30 minutes. And that's the key, again, about efficiency and speed, and you can do that with the customer. And that's where the innovation comes into it. That's where adopting platforms that actually provide you with the responsible lending ability to look at the transactions, to find those undisclosed debts, to look at the data and use a brain that can analyse and say, you've had a change in spending habits. What is that change? So that the broker can then ask the right questions. Because that's the key. You talked about it earlier, Brent, asking the right questions. So you talked earlier about gambling. Okay, if you did an assessment on a customer at spring racing carnival time, I'd never get a loan, ever. It's I've got racehorses, and that time of year I like to gamble.
Wouldn't happen.
It wouldn't happen. But the other 9 months of the year, there's nothing.
Yeah.
So, but again, it gives the broker the ammunition to ask the customer, say, is this just a temporary thing for this time of year, or is this a real change? You can look at the data, and if a customer is sitting there looking at buying their first home, or looking at growing from a first home to a next home, and there is a question on every loan application, do you know of any information that will change your ability to meet these repayments? Along those sort of lines. And that the customer data that you're receiving shows that the last 3 months they've spent a lot of money at baby bunting, and the 9 months prior they spent nothing.
Yep.
Like, do you ask the question? You're changing spending habits. What's happening? Now, if it's a 70-year-old, they're becoming a grandparent. But if it's a 25-year-old looking to buy their first home, it's a legitimate question that a broker should be looking at. And just getting the statements, you're not going to look for that. You need the technology to provide that, and that's what platforms. Ours obviously provides that. So I'm talking to obviously our capabilities, but others are looking at doing that as well, and others will do that. And open banking will enable that to be done easier as well, with the sharing of banking, sharing of data. That's where technology helps. It takes that onerous oh shit moment from the broker going, what do I do with this, to actually leading them on the journey of having that discussion with the customer. And doing that qualification, and that's where the innovation is coming. That's where our innovation obviously is coming from, and that's where our platform is so successful with lots of groups and lots of brokers from that perspective, because we're leading them on the journey. Brokers want to be led. Brokers want to make sure that the and it's probably a generalisation. Don't shoot me, people who are writing in saying that's not true, but a lot of brokers want to be led, and I think you've seen that. Your technology, they want advice. They want the statements on what are the expense categories. They want help with the know your customers. They want help with all the fact finds, all that sort of stuff. And that's why aggregators are there, to help the brokers and do that and help the businesses. And they have coaching and they have all that sort of thing. So the innovation comes from that perspective, giving the broker the ability to take a really arduous task and basically simplifying it for them.
Yep. Brendan, we're going to go to some questions here, but I do have one question for you, and that's I just want to get your perception around how brokers navigate innovative offerings, new technology, and things like that. How tech savvy they are. But I think more than the technology and operating technology, it's about the decision being made of what is a human job, what is a broker job as a human being, and what is this can be done by technology. Because I think sometimes that can be a tricky thing to understand. You know?
No, it's a good question. I mean, Brett covered off on a lot of it. I mean, the digestion of data is the challenge for brokers. You've got the data, how do you digest it and then have the right conversation? So, and it's getting more and more complex. So through aggregator platforms, with using, for example, Opica and Rely, that helps digest the data and then enables the broker to have the right conversation. We were touching on before about health and well-being, and there's a lot of experienced brokers, all brokers, feeling the stress of their clients at the moment, and it's being amplified through the complex credit process that will continue. So And we covered off about how lenders are assessing things, and that's just the reality of the game it is. And I think what we can do through using technology and data and digesting the data, it helps you get to the place quicker where you can have the right conversation with the client to understand their needs and then articulate that to the lender to get a decision in a more efficient and effective time. Does that make sense?
So that's that human interaction.
It does. And the interaction, and it helps the broker connect what the customer's trying to do at that particular point in time. They get to digest it and tell that story, my words, to the lender and get the appropriate solution put in place.
Yep.
That's the opportunity through technology and digesting the data and using platforms and innovation and AI to do it. Yep.
Mm-hmm.
It's humanising artificial intelligence.
Yeah, I like it.
Actually, I like to call it digitising the manual process, but I like what he calls it
There
too. Yeah.
All right, we've got quite a few questions that have come in from the audience. Oh, in fact, a lot of them are some of the things we've already touched on. We talk about responsibility with the focus resting on the broker/lender. What responsibility should rest with the customer?
Yeah.
We've touched on that.
One, yeah.
Got a comment here from Nikki. The CIF good customer outcome. Why is this not an industry standard across all platforms? Why are brokers the only platform being lopped with this? Good customer outcomes.
I think that's a great question. Let's see what plays out.
Yeah.
To be honest, I mean the Combined Industry Forum, the longer term strategy is to turn the what's coming out of that initiative into a code, and that's and then I suppose where Nikki's getting to is apply the same thing to lenders in branches or banks, for example,
and other industries.
Sure. And it'd be fair to say that watch this space. This industry is taking a leadership position, and to give you, and particularly learning from what happened in the wealth space. So where that industry did not work together as an industry to solve for what needed to be solved for. Mortgage and finance broking learned from that, and so that's an example of how by taking a leadership position you can change the game in a positive way, in a long-term way. So watch this space would be my answer to that. I think it will play on beyond.
Yeah.
Yep.
Well, the breadth of members who are working on the CIF, industry leaders, industry group, both industry major industry, MFAA and FBAA, most of the major lenders, most of the secondary, most of the aggregators, most of the you've got everybody there.
Yep.
Everybody's effectively got a seat at the table, and it's now just a matter of the round table being in agreement and things. And I think they will do that. It may take time, but I think the fact that they're all at the table is the first positive step in a long time.
And the industry's doing it to themselves, and the 6 initiatives under the Combined Industry Forums have clear deadlines. And you would have seen that's been announced in the media recently of the update and where the CIF is at. And a lot of stuff has to be delivered by the end of this year, and then all wrapped up by 2020. That's not too far away, and so that will continue that leadership position will continue to make a difference, and it'll play across elsewhere in financial services and beyond.
Like you touched on, Brendan, I think it's important that we have that blueprint of things to learn from the financial advice space, so that we don't get fofed in a corner. We've got a question here from Isabella. Do you feel that this process around an expenses checklist will be the norm moving forward, or should it be refined to represent a more realistic checklist? I'm guessing this comes down to the Netflix type stuff. Yeah. I mean, do you think this is the standard now with the granularity, or is it?
No, I don't think the granularity is the standard. No. That's the knee jerk.
Absolutely.
That's the fear Royal Commission stuff.
That's the fear factor of, what is the Royal Commission going to come out, and let's just go to the nth degree now.
Worst case scenario, and
let's pare it back, because it's easier to pare things back than continually
very good point.
Stringent, make things stricter and stricter and stricter. I think once the Royal Commission comes out with their findings, and because they won't come down with rules and say you've got to do this, it'll be a finding, and everyone will have to interpret the finding.
Yes.
Is that next year there will be a greater approach, and a lot of this I think will come from the CIF as well, because of of everybody being involved in it, and there will be a expense categorisation standard that I think the bulk of the lenders will agree to, not 100%, but probably 70%. The standard categories. And I think it'll still be the higher of HEM or disclosed, or the lower of HEM or disclosed, whichever's disclosed, right? And it'll be, again, the know and show. It'll be, and then each lender will have to make up their call of those categories, what do we want to include, what do we want to exclude, or what is mandatory, what is discretionary, and they will each have an adoption about that. But the fact that there's industry talking about it now, and brokers are adopting platforms like Rely, left, right, and centre, there will be there will be some data then that says, okay, based on real life data, this is how does that formulate process assessment protocol in future?
Yep.
I can speak from authority as a neo-lender with a massive commitment towards responsible lending. We think it is an overreaction. Into the future, my firm will be taking a scientific approach to responsible lending to our competitive advantage. Like the use of such things as
Watch this space.
Rely. Watch the space.
All right. We've got a question here from Emma. As an industry, when can we expect to see standards adopted in this space, more specifically around the distinction between living and discretionary expenses?
Again, interpretation by each individual lender. I'd love to look. I've got a model.
Yeah.
I've got a view on what's considered mandatory and discretionary.
The interpretation is the problem here.
So take school fees.
Yes.
So that's a real common thing.
Yes.
Private school education is a discretionary expense. By law, you have to have your children in school, and depending on the states, but it's from 6 years of age above. By law, that means a state school, which is basically free. It costs you books and clothes and very little thing. Then a Catholic education, which is a little bit more expensive. Then you have private school, which is way still expensive.
Yep.
That's a complete and utter discretionary cost. So in the event of financial hardship, the family who is struggling to get past,
They will take their kids out of the
most
school.
definitely.
Yep.
And where my daughters are at a private school, and I've seen very wealthy families who have hit on hard times, and those children next semester are not in, probably because their families have hit financial hard times.
Yep.
So, whilst educating your kids is a mandatory obligation, how you do it and the cost associated with is purely discretionary.
Yep.
Same with the type of car you drive. Drive an expensive car, or do you drive a Tesla? Or do you drive a Toyota? Again, Again, it's the interpretation around it. Our system automatically takes school fees above a certain amount to be discretionary.
It's an understandable question. I mean, brokers are running a business and they're talking to their clients. They're wanting some sort of guidance about, what's acceptable and the standard. And I think so. A couple of things that are playing out through the combined industry forum. The lenders are working on a broker interview guide that will get some more consistency about, for example, living expenses. And we use to our credit reps, and we share it with the ACL holders that aggregate with us as well. It's an expense checklist at the moment that we believe is as close as possible to all the different variations that you can get across lenders currently. So there's the intent there from an industry perspective to provide that clarity to a broker, so it's more efficient and effective in gathering the data to have those better conversations. And it comes a bit to before where the competitive advantage is for lenders now is to be more crisp about their risk or credit appetite, my words. So what's the type of business that we're looking for? Because in the competitive offering that we, or industry that we operate in, we've got so many lenders that can fit, for just about anyone, if you know what I mean. And so that's the opportunity for lenders to be crisp about their credit appetite or risk appetite, their customer profile. Yep.
James, I'm conscious time's going by, but I'm fishing for a question now. Is there any questions about so-called mortgage prisoners?
Actually, you know what? I think there is. How are we doing for time? I don't have a watch.
7 or 8 minutes.
No,
7 or 8 minutes. All right.
Yeah, well, that's I think that's topical.
It is topical. Actually, I do have one here. It's a question actually provided by Taz Bindi, who's our features editor on The Advisor. She wrote up a few questions for me to throw to you guys. Thousands of Australian mortgagors could be trapped with their existing lenders as credit criteria becomes increasingly stringent, making it difficult for them to chase a better deal. There was a Mozo study that came out about this. What are your thoughts? Actually, I wrote an opinion piece about this a couple of months back because it's something which has happened in the UK for different reasons. But basically, being trapped in a mortgage, you can't refinance out of it.
It's really interesting, isn't it? Particularly if you've been paying on time. You have an unblemished record for 3 to 5 years, and it's demonstrably in refinancing is in your so-called best interest, and you can't do it. It's interesting. I don't have the answer.
Well, I know the one thing which I found pretty striking in the Productivity Commission interim, or the draft report, was when this whole idea of, and this was their argument with, thinking trail wasn't such a great idea, was, well, it makes it harder for them to switch, you know. But that was under, again, this comes, that was an interpretation that switching must be a good thing.
Well, normally it is to take advantage of a different cost of funds, a different cost base, those things.
Sure.
I think,
Or you can use the switch as leverage and just
and
negotiate.
go back to your existing lender, and that happens a lot. That happens. Hell, I've done that on a couple of my mortgages. It happens a lot. So, but I think mortgage prisons is going to be now, here and now. There'll be certainly people who want to get out, want to get a better deal, and can't because of the knee-jerk reaction at the moment. Because of the stringency of what people have gone to this end. I give it 12 months, and I think it'll be yesterday's fish and chip wrappers. I think the tightness of what they're doing today will be stringent as technology gets adopted more, as aggregation groups become more streamlined on what they're doing, and brokers understand the process more, and then the lenders will start following, okay, well, if this is what the distribution's doing, then we should be looking at this sort of process. We should be assessing.
It's real, it's there, but mortgage brokers are the ones best placed to solve for it. So they've got access to at least 40 lenders, and as I mentioned before, there's the still meeting the requirements of responsible lending. There is a lender out there that can meet most of those circumstances. So what it means is it's the broker in the putting the customer's interest first, and it'll be time and effort, but it'll be worth it. They'll be able to place their client in the right spot.
There's here we go. There's a question for Kim from Emma. Kim, can you explain your comments on taking a scientific approach versus the current environment where brokers use a more human, pragmatic approach?
Put your propeller hat on.
Try not to actually give Brett's company an outrageous plug, but the correct, timely use of data, particularly around income and expenses by platforms such as that promoted by the gentleman to my right, is a big element of it. And also using comprehension tools and maybe tools that are independent of the broker or the lender to ensure that the 6 pillars of the NCCP are in place. So you know that the people are getting a product that suits their needs and objectives, and they know they have to pay it without substantial hardship. And they really understand the nature of their obligations is the other side of that scientific approach. And
we've got, we had an exciting question here about whether regulation was useless. Where is it?
Yeah, why be responsible?
Here we go.
What's the point?
Yeah, what? Yeah, well, yeah.
Caveat emptor.
Caveat. Well, you know what? That's a really good point.
I was around for how many
2,500 years or so.
That's it. And Wayne Byers from APRA, he raised it at this talk he was giving in Sydney at the Ivy Ballroom a couple of weeks back, which I thought was interesting. You know, because
what was the context of that, James?
I mean, it was basically he was talking about the mortgage market and all the macroprudential measures they've put in place, and it was sort of like, but at the end of the day, caveat emptor. Goodbye, everybody.
Well,
so I think regulation has the rightful place where it is today. But what I'd like to say, and I've said this for 25 years, is regulation should give us some rules to follow, not just some guidelines to interpret, because interpretation is what causes the mystery and causes the issues. If you want to regulate something, regulate and tell me what I can and can't do.
Yep.
Don't give me a guide that says, oh, maybe you can do this, maybe you can't do this. Just tell me what I can and can't do. Then all of this mystery goes away. Everything goes away. If you tell me this is what you have to do, I'll go and do it. It's like rules on a football field.
Good point.
That's it.
Well, I think we've run out of time, gents. Thanks very much for taking the time. I think we had a fantastic discussion.
Pleasure.
And hopefully all you brokers out there who've tuned in have enjoyed it as well, and you've got something out of today. Do continue to leave your comments, and we'll be back next time with episode 2. Stay tuned.